If you set this plan up for a grandchild that was born within the last year, if they're under the age of 1, all you have to do is just open an account, and the state of Connecticut's going to give you $100 into that account. You don't even have to put anything in. But they make it even sweeter that if you put $150 in, then they're going to give you $250. So if you put $150 into an account for your grandchild or for your child that is under the age of 1, then shortly thereafter, you'll get a credit into your account of $250. They do it on a quarterly basis.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is part 1 of a 2-part episode on 529 plans, and specifically Connecticut's 529 plan, which is known as the CHET plan, the Connecticut Higher Education Trust, which is a direct plan, meaning that it's not sold by an advisor, that you can buy it directly. There is another plan available through Connecticut, the CHET Advisor Plan, but I don't recommend that plan, and we're not going to focus on that at all today. And there's been some recent changes with that plan, and that's part of what I wanted to go over, as well as just talking about some of the ways that this plan could help you not only save for college, but give you a tax credit that you might be in need of. So I have an account set up for my son with the CHET plan. I set it up a few years ago, and I received something in the mail telling me that the plan provider was changing from TIAA CREF to Fidelity. There wasn't a lot of notice, unfortunately. I think there was about a month advance notice of when this change was going to happen. So for me, it was not too bad of a change because I already had an existing Fidelity account, and in the notice that was mailed out, it did say that after a certain date, I believe it was February 8th, you'd be able to log into your Fidelity account and you would see your 529 account there. So that did happen. If you have listened to my previous episode on health savings accounts and the benefits of those, you'll remember that Fidelity is one of the providers that I recommend using. So that's why I had an existing account with Fidelity. And what the instructions say is that if you don't have an existing Fidelity account, then you have to set up a username and password to be able to log in and access your 529 plan. So before we talk about the specifics of the changes and what some of the pros or the cons are, I just want to go back and talk a little bit about 529 plans, how they work, what some of the benefits are. And another good episode to listen to would be episode 14, which is how to help your grandchildren pay for college. And in that episode, I talk about the different options, and I do also talk about 529 plans, but I want to expand upon that. So a 529 plan is a qualified account that allows you to set aside money that can be used for college and even elementary school expenses, and also some vocational schools as well. And it's considered a triple tax-free account in the sense that, like a health savings account, money that you put in can qualify for a tax deduction or a tax credit, depending on the state that you live in. And the money grows tax deferred. And if you take it out for a qualified expense, then it's a tax-free distribution. So it's really great in that sense. And you're able to contribute based on what the plan allows. So for the CHET plan, the plan allows for $300,000 that can be put in any one shot into the plan. Once your account either hits $300,000 or once you've contributed $300,000, then you no longer can make a contribution until the account falls below $300,000 again. So if you were to do that, however, you'd have to worry about some gift taxes potentially. So in order to avoid that, you can use up to 5 years of your gifting in any 1 year. So the current gift allowance is $15,000. So you could gift 5 years of 1 year into a 529 plan for a beneficiary. So you could put $75,000 in. Yourself, if you're married, your spouse could do the same thing. So you could put $150,000 into the CHET plan, and that would probably cover a lot of your child's college expenses. You wouldn't have to worry about any gift taxes. But however, you wouldn't really be maximizing the Connecticut state tax credit that is available to you. So I believe there are 34 states that offer some type of tax credit or tax deduction on contributions that go into the plan. And really, it's only states that have state income tax, and not every state does, but Connecticut is one of those states. So with Connecticut, you're able to put up to $5,000 per year into a 529 plan per person and take that amount as a deduction on your Connecticut state income tax. So Connecticut state income tax starts at 5%. So worst case, if you put $10,000 in between you and your spouse, then you're able to get a $500 savings or tax deduction on your Connecticut state income tax. If you're in one of the higher Connecticut state income tax brackets, then there could be more savings. So the way to take advantage of that is that if you were saving for college and you were trying to set aside a good amount of money for your child, maybe for however long you could, you put in this maximum $10,000 per year. Now you could put more than that in any one year, but you're only going to get a tax deduction on your Connecticut state income tax for that $10,000. And then you allow the account to build up in that way. You also could do this on behalf of your grandchild. You could set up a 529 account as well, and you could make the contribution, and you could also get the tax credit up to $10,000, $5,000 per person. If you're a joint filer, then it's $10,000. And currently, there is no restriction on anyone being able to do that. For example, anyone can do that. You don't even have to have a child. You can make yourself the beneficiary currently. So if you wanted to get this tax credit, you could put the money in, get the tax credit, and now the money's in the 529 plan. And there isn't currently a tax recapture, meaning that if you put the $10,000 in and you took the tax credit, and shortly thereafter you took the money out, there's no tax recapture. So you technically could put the money in, shortly after, take it out. And you'd want to check with your accountant on it and make sure this is a strategy that works for you. But as far as I understand, that's how this can be used. Now, it's not designed probably to put the money in and take it out. It's designed that you put the money in, you get the tax deduction, and that you leave the money in there and you let it grow for a period of time. Additionally, there are some protections as well when you put money into a 529 plan. One is creditor protection. And I should mention too that a lot of this information that I'm giving to you, I got from the brochure that goes with the 529 plan. It's a rather lengthy brochure. It's about 100 pages. And if you go to aboutchet.com, that's where you can find out all this information that I'm talking about regarding the CHET plan. And on that website, if you scroll down a little bit, you'll see plan application and fact kit. And if you click on the fact kit, this is that document that goes over all the ins and outs of how this plan works. And one other thing that's mentioned in there, I was saying earlier about the creditor protection, is that if you file for bankruptcy, part of the assets inside of the 529 plan can be protected. It goes on to say that Connecticut follows the federal bankruptcy guidelines that as long as your contributions are more than 720 days before your bankruptcy, then they're protected inside the 529 plan. Less than 720 days to 365, there's a certain amount that's protected. I think it was like $6,000. And then anything less than 365 days is not protected. So you want to check with a bankruptcy attorney on that. But there could also be some bankruptcy and creditor protection, which is kind of neat. So additionally, too, if you set this plan up for a grandchild that was born within the last year, if they're under the age of 1, all you have to do is just open an account. And the state of Connecticut's going to give you $100 into that account. You don't even have to put anything in. But they make it even sweeter that if you put $150 in, then they're going to give you $250. So if you put $150 into an account for your grandchild or for your child that is under the age of 1, then shortly thereafter, you'll get a credit into your account of $250. They do it on a quarterly basis. This is called the Baby Scholars Program. And also, if you scroll down on the main About CHET page, you can see some information about this. The requirements are that you do it before the child turns 1, with the exception being that if there is an adoption, you can do it within the first year that the adoption occurs. And the other thing is that the child has to be a Connecticut resident. But I did this for my own son, and shortly thereafter, the credit was put into the account. So it was awesome. So as far as some of the changes that went on, as I mentioned, this plan moved over from TIAA CREF to Fidelity. And anytime there's a change, you want to be aware of what's going on. Are there benefits to you? Are there negatives to it? So I want to go through some of those. So the main thing, other than the tax credit that you're looking at with a 529 plan, is what are the investment options inside of the plan? And how are those investment options, what are the performing? You could look at past performance, but also what are the costs of those investment options? So this CHET plan, before the change, definitely had a mixture of investment options that were on the lower side. Another good website to go to if you want to research 529 plans in general is savingforcollege.com. On there, if you click on 529 plans, you can click on the plans available in your state. Or if you're looking just at overall 529 plans, you could look at plans. There's a lot of free information you can pay to upgrade. A lot of the stuff you can get without paying to upgrade. But back to the changes in this plan. So now that the plan is with Fidelity, you have 37 investment portfolios you can choose from, 37 different mutual funds. And each mutual fund works a little differently. And from there, you can really break it down into 3 different options. Option 1 is 3 what they call static portfolios: aggressive growth, moderate growth, and conservative growth. And aggressive growth is 100% stocks, moderate is 70% in stocks, and the conservative portfolio is 100% bonds and cash. And these allocations stay that way. They don't ever change unless Fidelity decided to change them, but they'd have to notify you about the change in allocation. Then your next option is the individual fund portfolios, where you can choose from 6 different investment options, 1 being a money market, 1 being a bond fund, 1 being an international fund, another a U.S. stock fund, and then another an international fund, and then another U.S. stock fund. So that gives you more freedom to build your own portfolio, choose how much you want to have in bonds, how much you want in U.S. stocks, how much you want in international. And then your third option is what they call age-based portfolios that have a year in the name. For instance, the 2039 fund. So that year is supposed to correspond when your child will be going to college. So if your child will be 18 in 2039, then one of these portfolios could be appropriate for you. And the more time until your child will be 18, the more that these funds have in stocks versus bonds, right? Very simple concept. You want to be more aggressive with your portfolio, you keep more in stock funds. You want to be more conservative, you keep more in cash and bonds. So for example, the 2039 fund has 95% in stocks. How this 2039 fund is designed and how all target date 529 plans are designed is that the closer you get or your child gets to their 18th birthday, the more money that gets shifted into cash and bonds so that the account is more protected from possible stock market declines. And if you want to see what that looks like, you can go to page 13 of the brochure, and on there is a chart that shows the fund, and based on the number of years until college, how much of that allocation changes between stocks, bonds, and cash. So you could pick one of these, and this is a simple way to possibly pick a portfolio that aligns with the risk that you're able to take, because theoretically, if your child is going to college in the next 5 years, you'd want to be more conservative than if they were going to school in 15 years, because in the next 5 years, maybe there's a decline in the stock market and you need to use that money for college. So you wouldn't want to find out that you have less money to spend on college than you were planning. So that's the theory behind putting more in cash and bonds the closer you get to actually using the money, probably within 3 to 5 years of using it. But that might not be appropriate for you. So within those age-based portfolios, there's then also 3 different options. One being an option of all Fidelity funds that are actively managed, and another option being Fidelity index funds, which are passively managed, which have a lower cost than the actively managed funds. And then the third option being a blend of the two, that has a mixture of index funds and also actively managed funds. So when you're looking at the static funds, that's where you're going to find the lowest costs of any of the portfolios. You can probably hear some of my papers ruffling in the background because as I said, there's 100 pages in this brochure. And, to get to some of these costs, you have to dig deep. There is some stuff right on the Fidelity website, on the About CHET website, that does say that for the index funds, that either being the age-based index funds or the individual funds, the fees range from 0.11 to 0.20, and that's a really low cost for any investment in general, but also for 529 plans. And then if you go to the all Fidelity actively managed funds, the fees range from 0.5% up to a little under 1%. For the blended portfolios, that's a mixture of index funds and actively managed funds. It goes from 0.4% to 0.6%. And then there's also a bank deposit program, and that ranges from 0.05 to 0.5%. So the cost is pretty low, but if you wanted to keep it really low, I would stick more with the index-based target date funds or use some of the individual fund options. For example, the Fidelity 500 index portfolio is 0.11%. So that's a really low cost. So as far as making changes to the account, this is definitely a good time to look at that because there's been a switch over from TIAA to Fidelity. So looking at what you're in, maybe you don't even know what you were in. I've sat down with clients and they have young children and they're in one of the more conservative fund options, which is probably not the best thing for them. So assess where you're at, but you're limited to making a change twice per every 12 months within your plan. So if you made a change recently, then just keep in mind if you make another one, then you're going to have to wait a while to make your next change. So make those changes carefully, but it's definitely a good time to review what you're in. Please tune in to next week's episode for part 2 of the CHET plan review, where I discuss some of the pros and cons of the change from TIAA CREF to Fidelity, as well as the different ways that you can withdraw money in a tax-free manner from the 529 plan. Also, as a reminder, my retirement readiness workshops are going on right now, so there's still an opportunity to sign up for these online classes where you can get a better handle on your own retirement planning, put a plan in place, or possibly even update your existing plan if it's in need of some help. So to learn more about that, go to retirewithryan.com or morrisseywealthmanagement.com. Look forward to talking to you next Wednesday. Have a great week.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.